Investments in Marketable Securities, a presentation by Candace Anderson, Mike Larkin, Seth Quinn, and Stephen Hilton. This presentation will cover financial accounting for marketable securities, including unique issues brought about by FAS 109 accounting for income taxes, and the effects of marketable securities transactions on taxable income. For our financial accounting purposes, we will discuss two different classifications of securities, trading and available for sale. Also note that the following principles assume that a company holds no significant influence in the company whose stock it purchases, which generally means that they hold 20% or less of the outstanding stock and are not required to use the equity method. Additionally, we will not be discussing held-to-maturity securities. First, let's talk about trading securities. A trading security is a security that a company plans to sell in the near future. The Accounting Standards Codification Glossary states that trading generally reflects active and frequent buying and selling, and trading securities are generally used with the objective of generating profits on short-term differences in price. For example, X Corp buys shares in Y Corp on January 1st of year 1 and intends to sell them before March 31st of year 1. These securities are properly classified as trading securities. Now, let's talk about available for sale securities. An available for sale security is a security that a company has purchased and does not intend to sell in the near future. So, if X Corp buys those same securities from Y Corp on January 1st of year 1, but plans to hold on to them for the foreseeable future, then they are properly classified as available for sale securities. Let's now discuss some of the complex issues involved in accounting for marketable securities through an example. Suppose that on January 1st of year 1, ABC Company purchases 100 shares of stock in XYZ Company at $100 a share for a total of $10,000. Suppose also that ABC intends to sell the shares in the near future. The proper journal entry to record the purchase of the securities would be a debit to investment in trading securities and a corresponding credit to cash, each for $10,000. Now suppose that on June 31st of year 1, XYZ Company declares a dividend of $1 per share. Since ABC holds 100 shares, it would record a debit to cash for $100 and a credit to dividend revenue of $100. At the end of the year, the trading securities need to be adjusted to reflect changes in their market value. If the investment's value is ascertainable from an active market, an adjustment account is created and maintained until the investment is sold. Otherwise, no adjustment is recorded. Suppose that at the end of year 1, the value of one share of stock has dropped to $92. We now need to record a debit to unrealized loss and a credit to the market adjustment account. Suppose also that at the end of year 2, the value of one share of stock rises to $115. The journal entry to record this change is shown to the right of the T account. We adjust the market adjustment account by $2,300 because that is the amount that will bring the T account to a $1,500 debit balance. The unrealized gains and losses hit the income statement in the year of adjustment. Suppose the stock is sold for $116 per share. ABC receives $11,600 cash, resulting in a realized gain of $1,600 after removing the investment of $10,000. Because this investment is no longer on ABC's books, it must also zero out the market adjustment account related to the investment. To do this, we debit unrealized loss and credit the market adjustment account by its remaining balance of $1,500. This unrealized loss hits the income statement in the current year. The journal entries for available for sale securities are very similar to the journal entries for trading securities. The original purchase and the receipt of dividend entries remain the same. Available for sale journal entries differ from those for trading securities in regards to the market adjustment and unrealized gain-loss accounts and the journal entries when they are sold. When a market adjustment is recorded for an available for sale security, the unrealized gain stays on the balance sheet in the equity section under Accumulated Other Comprehensive Income. Unlike with trading securities, the unrealized gains and losses on available for sale securities are shown net of deferred tax assets and liabilities. Assume that the XYZ securities were classified as available for sale rather than trading, and the tax rate is 35%, and we would have the following journal entries. The unrealized loss is shown net of tax at $520, giving ABC a deferred tax asset of $280. In year 2, when the stock price rises to $115, ABC will debit the market adjustment account, just like with the trading securities, and will show an unrealized gain net of taxes at $1,495. The difference is then credited to two different deferred tax accounts. First, ABC will write off the deferred tax asset of $280. The remaining difference creates a deferred tax liability of $525. Suppose once again that the stock is sold for $116 per share. We receive cash of $11,600, resulting in a realized gain of $1,600 after removing the investment of $10,000. Unlike with trading securities, we use other comprehensive income to close out the market adjustment account because that is the account we have been using to track changes in the value of the securities. Every time we recognize an unrealized increase or decrease to OCI, we must recognize it net of taxes, thus yielding a debit to OCI of $975, a debit to deferred tax liability for $525, and a credit to the market adjustment account for $1,500. This journal entry effectively closes the market adjustment account and the unrealized increase to OCI for the security. We will now discuss the tax accounting issues related to securities. In a simplified format, net income is calculated by taking revenue and gains and then subtracting out expenses and losses. Any gain or loss from a trading security goes through the income statement, realized or unrealized, and will affect pre-tax financial income. These unrealized gains and losses need to be removed from income to arrive at taxable income because recognition of gains or losses does not occur until the underlying security is actually sold. These unrealized gains and losses from trading securities will create deferred tax assets or deferred tax liabilities. Unrealized gains and losses from available for sale securities also create deferred tax assets and deferred tax liabilities as the AOCI account is reported net of tax. Please see the following simple example. Assume financial net income is $2,000. Unrealized losses for the year amount to $800. The tax rate is 35%. Unrealized losses are added to the pre-tax financial income to reach taxable income. Using the tax rate, we see the current tax expense is $980. The $800 unrealized loss creates a deferred tax asset because the loss cannot offset taxable income this year, but will in the future when the asset is sold. This is the journal entry to record the deferred tax asset. Now we will discuss how the tax accounting issues change if the taxpayer is a trader of securities or a dealer of securities. If the taxpayer purchased securities for investment purposes, and such securities were not at any time for sale to customers in the ordinary course of business, then the taxpayer is considered a trader of securities. For tax purposes, these securities will be considered as capital assets. Conversely, if the taxpayer purchases securities with the design to resell them to customers, and such sales are made in the ordinary course of their trade or business, then the taxpayer is treated as a dealer of securities. In this case, the character of the securities for tax purposes are considered as ordinary, and any gains or losses will affect ordinary income. The significance of this tax difference is shown by the following example. Company M&O holds its securities for investment. This is the first year of business for Company M&O. At a future date, M&O sells the securities at a loss of $500. This is a capital loss which, for tax purposes, can only be offset by capital gains. If no capital gains exist, the $500 creates a capital loss carry forward, which results in a DTA. Now look at the same example, but assume that M&O purchases securities primarily for resale to customers in the ordinary course of their business. M&O sells the securities and realizes a $500 loss on the sale. The character of this loss is ordinary, so it can be offset by ordinary income to the extent that ordinary income exists. If no ordinary income is available, the loss becomes a net operating loss, which results in a deferred tax asset. As you can see from these two examples, having losses from the sale of securities as a trader is more restrictive than losses incurred as a dealer. This is because capital loss carryforwards can only apply to capital gains, whereas net operating losses can offset ordinary income. We hope that this presentation has been both informative and worthwhile.